Hey guys, those of you that know me know that I took a trip to Egypt back in June. We had a wonderful time. It was about, I don't know, 10 days, traveling up and down Egypt on the Nile River. We had a wonderful time. But as we were floating on the Nile, going from site to site, there was a bit of downtime. So I wanted to get, some knowledge base, I guess. So I took the opportunity to read a book called The Income Factory, and that is a book written by Stephen Bavaria. And I really like the subtitle of this. The subtitle is An Investor's Guide to Consistent Lifetime Returns. And what that seemed to mean to me is, I don't know if you guys remember this. Some of you are too young for this, but some of the guys who are closer to me in age will remember the old Ronco oven, and the mantra of the Ronco oven was to set it and forget it.
Put it in the rest area. Push it back. You slide the window up. You follow all instructions, and you set it and forget. Right. Set it and forget. Right. Set it and forget. Right.
That's kind of what I think Stephen Bavaria is attempting to accomplish with this book. I want to go through my thoughts on what he's proposing, and I think he's got a good premise, but there's some problems with it. And I want to share both. What I'm going to try to do a fair assessment of the book, but I also want to give my thoughts on what he's proposing and whether it's going to work for us as a long-term strategy. So this is going to be an exciting video. I appreciate you being here, and let's get started. Okay, for those of you who don't know me, my name is Kevin Burgess. I've been retired for a couple of years now. I'm living off passive income, and I just basically like sharing what I do in my passive portfolio. Maybe it gives you some insight into some things you can do in yours. Maybe it shows you some things that you shouldn't do in yours because, we all make mistakes. But either way, there's some value there to you. I want to share this with you. I'm completely transparent with my portfolio. And as a matter of fact, I plan to do a portfolio update probably on Tuesday because Monday is the end of July. So I'm going to give you a July update on the portfolio. That should be exciting because I've got some new stocks in the portfolio. You're not going to want to miss that. So if you're interested in growing your portfolio, if you're interested in dividend stocks, if you are just interested in talking about dividend stocks, consider subscribing to the channel. I'd love to have you along for the journey. And with that, let's get started. Hey, it wouldn't be a book review if you don't grab like a cup of coffee, cup of tea, maybe something a little stronger, and just sit back, relax, and enjoy the flight. So we're going to talk about this book called The Income Factory. So before I do that, I'm going to get a sip. Okay, let's get started. The Income Factory, and the question I want to answer here is, did The Income Factory change my investing strategy? Okay, just a bit of a disclaimer here. This review is based on my perspective. So that, I'm looking at it from my perspective, and Bavaria discusses investments and risks related to both equity and credit risks. And there's a lot of content in this book. So I would suggest that you buy this book, read it for yourself. There's a lot of good content in here, a lot of good learning in here. I'm not going to be able to cover all of that in this video because it wouldn't be fun for either of us. So I just wanted you to know that as a disclaimer, I'm not going to be sharing everything out of this book. I would suggest for you to buy this book and read it. I think it's really well written, and it's a good book to read. So the first thing we'll talk about is, what in the world is an income factory? I mean, you've never heard that term before in investing. What is this income factory? He calls it a river of cash. So this cash, it comes in the forms of either dividends or cash distribution, and it doesn't matter to him what happens to the remaining value of the securities. As long as that security continues to pay that form of distribution for in perpetuity. So another way maybe to visualize this is that it's and it's an income producing factory. And so our goal is to actually buy a bunch of factories that are continuously basically churning out cash. You can also think of it as one factory with a bunch of different machines within that factory that are producing products that are producing cash, and that product would be cash that just continue to produce cash, and they'll deteriorate, they will depreciate in value, but at the end of the day, they're still producing those products and they're still producing cash. So that's kind of one way to think about what he has here in the income factory. So, what is the premise of the income factory? Most investors expect an equity return of 8 to 10%. And he makes a great point in the book. That point is that the reason that we can say that most investors expect 8 to 10% is that in the long run, that is what we have seen in the marketplace. So if we're looking for more than 8 to 10%, it's probably not going to happen over the long term in the stock market, because historically, on average, it has not done better than that. You've had times where you've gone down 20%, times you've gone up 20%, but on average, over the long term, it's an 8 to 10% expected return in the market. Another premise in his book is that the cash received, whether that be through bond payments or dividend payments, that cash is real, whereas any change in the portfolio, he considers that to be theoretical until it's sold or harvested in some way. Now, if our portfolios produce a real cash return of 8 to 10%, then in his view, we don't need to stress over the market growth of the securities. And the reason is that if we're getting cash equal to 8 to 10% per year consistently, then we shouldn't worry about what the investment's doing, because we're getting the return that we're looking for. Another premise is that if the market prices drop on those particular securities, and you're continuing to build wealth, then you reinvest that 8 to 10% real cash into a declining asset balance, and it actually helps your income grow even more over time. Also, his premise is that the investment income drives the underlying valuation of the investment. Why is that important? That's important because if you're getting consistent stream of income, his premise is that you will continue to have a relatively consistent asset value over time. And then lastly, another premise of his book is that the investments that are selected for the income factory need to make those cash returns indefinitely. So those are important premises to keep in mind. It's a little bit different than what we think about today, where we typically will look at either a growth stock and we will buy that stock and looking for the business performance of that company to drive. Maybe they've come up with a new widget, a new way of doing business, and that stock is going to grow. So we're looking for that. Or you're looking at some kind of dividend versus, growth. So you're looking for companies who are paying a dividend but still growing. There's some companies out there who have reached the top of their plateau and they're basically paying dividends, not really growing that much. So we can select kind of any of those investments that we want. But what he is presenting to us is that we should look for investments that pay a high cash return, and don't worry then about how they're valued in the market. And one of the takeaways from this book is that he is really trying to deal with what I consider to be real issues. So let's take a look at some of these. History shows that investors do not have the will and fortitude to buy and hold through market downturns. I experienced this personally, back in the great financial crisis. The stock market just tanked. It dropped really quickly. And I had some friends who would ask me, hey, what are you doing in that time? And my response to them was, you only get hurt on a roller coaster if you jump off. So I'm staying on the roller coaster. I'm riding this thing. I'm buying all the way down. And then, I really believe in the market and it's going to come back. Well, it took several years for that to happen. But at the end of the day, some of my friends backed their investments out. They sold everything they had. They pulled everything into cash. And I don't know what happened to them after that, because we've kind of lost touch. But my guess is they lost the ability to get some return. So There's something about the psychology that we have as human beings that when the market crashes, we want to pull our money out to keep it safe. And in reality, we're only hurting ourselves. So history shows us that we've got a real issue when it comes to a market downturn. The second thing is the income factory provides a model to address the psychological and emotional stress that's experienced by investors. And, there's a lot of stresses. Let me give you a couple of examples. First of all, when I buy a stock, there's something that I call buyer's remorse. And it happens in a couple of different ways. So if I buy a stock and it goes up in value, then my remorse is, why didn't I buy more? And if I buy a stock and it goes down, my remorse is, why did I buy that then? Why didn't I wait? Right. So there's buyer's remorse, regardless of whether our stocks go up or down. So from his perspective in this book, he's trying to help us address that particular issue. Then theoretically, the income factory assets only need to produce their income for the long-term investor to be successful. So they don't need the return from the asset, they just need the income. The next issue is, we are bombarded daily. The stock price is the most important thing. And what Bavaria would say is, no, it's not really the most important thing. What's the most important thing is the cash return. And why is the cash return most important? That is because it provides a greater sense of security during market turbulence. So when the market is really turbulent and the prices of stocks are moving around a lot, if you're getting a consistent stream of income every month, that is quite soothing and quite calming, as long as that's where you're looking at and not looking at the price of the stock. So now I want to talk about some of the investments that he recommends in this book. Inside these pages, he actually has some charts that show different investments that he would suggest in different categories, like fixed income and preferred stocks. And so what I thought I would do is take one of each of those categories and let's test them. Let's see how they did over a period of time. So I think this is going to be really interesting. It was really enlightening to me. So I want to go to some more slides here. Okay, let's look at the first of Bavaria's suggested investments. He suggests that we invest in a ticker symbol called BGX, which is Blackstone GSO Long Short Credit Income Fund. These are basically senior loans. I wanted to share with you that the net asset value from 2014 to 2023 has continuously declined. And again, that's not a major deal for Bavaria, but I wanted to also show you over here on dividend growth that they did grow the dividend in June of 23 by 5%. However, the average for the last 5 years is a negative 5% per year, and over the last 10 years is a negative 3%. And the reason I share that is because in this particular investment, not only is the net asset value going down, but also the income is going down, which is not what you want in this particular premise of the income factory. The dividend yield currently is sitting at 11%. I wanted to show some total returns down here at the bottom. You can see that the 1 month return is minus 0.01, 3 month is 2.99. However, year to date is positive 4.28. 1 year return minus 3. 3-year return is a positive 5.75, and 0.45% on a 5-year annual return. 10-year is at 2.9%. So basically, this particular investment, the ticker symbol BGX, from a total return perspective, is pretty flat over a 10-year period of time. You're basically getting 3% per year, which is not an exciting investment from my perspective in the market. Now let's take a look at the next one. It's a high yield investment. It's called BGH, which is Barings Global Short Duration High Yield Fund. And again, the net asset value per share is going down. That is not a good trend. And then I look over here at dividend growth and I see they've grown the dividend by 0% since 2020. And in the last 5 years, it has gone down on average 7% per year. It's yielding about 9.76%. But again, guys, you look at this total return down here at the bottom, and it is not an exciting or compelling investment. They don't have a dividend safety rating in the Simply Safe Dividends. When I come to the next one, which is from a multi-asset perspective, he suggests an investment with the ticker symbol NCV, which is Virtus Convertible and Income Fund. That also is decreasing in net asset value. It is significantly decreasing in dividend growth. The dividend yield, however, is still 11.9%. The dividend safety, according to Simply Safe Dividends, is very unsafe. They gave it a score of 20. And if you look at the returns, the total returns down here at the bottom, you can see, again, not a very compelling investment. Over a 5-year time frame, you're losing 4% per year. So let's move on then to preferred stocks. So LDP, which is Cohen and Steers Limited Duration Preferred and Income Fund. Again, net asset value heading down. The dividend growth is 0%, is negative 3% per year over 5 years. However, on the 10-year, it's positive 10%. So it's pretty volatile in terms of its dividend growth. But then I got a yield of 9%, which is kind of fun. But I come down to the dividend safety score. It is a 30, which is considered unsafe. And I look at the total return, and I find out that over a 5-year period, it's pretty flat. So again, not a very compelling investment. So now let's flip the table a little bit, and let's talk about equity investments. And I wanted to utilize a ticker symbol VOO, which is an ETF that mirrors or mimics the S&P 500. So when I look at this, there's a few lines on here, but the ones that are important are the red/blue line that's going to go in like this. So this is a picture of the last 10 years of the S&P 500. It has gone up in value. Its dividend yield is only 1.54%. They don't do a dividend safety rating on the S&P 500, but if we look down at the bottom at the total returns, on a 3-year basis, we're looking at 13%. 5-year is 10.9%. A 10-year is on average 11.96% over this 10-year period. Now let's move on to SCHD. It is probably one of the most well-known ETFs that's focused on dividends. Their dividend yield is 3.61%. But you can see, year to date hasn't done so well, and over the last year. But over a 3-year period, it is 13.61% annual return, 10.75 for 5 years, and an 11.05. Now, the dividend yield is part of this total return, but you can see that if you invested in SCHD over the last 10-year period, you would see about an 11% return per year. That would obviously be volatile. I mean, check out this blue line. It goes up and down, and goes way down sometimes, comes way back up, and then comes way down and goes back up. So there's a lot of volatility to that. You have to be aware of that, and you have to understand that, as long as the trend is going upward, we really don't care about the roller coaster that it takes in getting there. Based on that, I think you can tell that I'm not really that excited about the income factory. I don't think it works. I know the math works, but I don't think it works in real life as investments go down in value. So if I'm getting a cash return, but I'm getting no other return, and actually it's going down because I'm not even getting to keep the return that's coming in cash, I don't think that really plays to what we want as investors. So when do we use the income factory? I think there are some important points here that we need to keep in mind. When is the income factory most applicable? And that is when the most important factor is income, mainly in retirement, and I would say late retirement. Number 2, you don't have any desire to grow your portfolio value. Number 3, now there is a hybrid strategy that he calls income factory light, and he discusses this in the book. And I believe Income Factory Light is appropriate at many stages of life. And I actually use that in part of my portfolio now. I thought I would talk a little bit about a couple of those. But again, this Income Factory Light is in this book. So you want to take a look at that in here. But I'll show you a couple of investments that I have that fit into this Income Factory Light. Now to do this, we're going to go into Simply Safe Dividends. I'm going to go ahead and display that on the screen here. This, as you recall, I have several different portfolios. One of those I call a dividend income portfolio. I basically look for stocks that I believe are going to continue to grow their dividend at some level. Doesn't have to be much, but some, but also that pays a higher yield, and so that kind of helps me from an income perspective. You can see that this portfolio right now is valued at $322,000. It is not my total portfolio, but it is it's in an after-tax account, so I get about $13,234 on this. This does not include any money that I'm getting from the money market account, and currently I have quite a decent balance of cash, which is about $65,000. So I'm getting some income from the money market account. But that aside, I'm getting an annual income of $13,234, which is roughly about $1,100 per month that I'm getting from this portfolio. So let's kind of sneak down here and look at some of the major investments that I have in this account. You can see that the top investment that I have in here is IBM. Now, I took a lot of flack from quite a few people a couple of years ago when I began to invest in IBM, and the feedback was it is a dying company. They are, it's a turnaround story. They're not going to turn around. And I began to look at their new CEO, their new strategy, and I was like, there is something to this hybrid cloud. So I went ahead and invested in IBM. Let's move back to this. You can see that the gain on IBM that I have, it's been a couple of years, so it's 11.4%. And my yield on cost is 5%. So if you take 11.4, let's just assume it was 2 years. I'll take 11% divided by 2 is about 5.5%. And then I get about 5% in yield. So if I take the 5% and 5.5% in gain and a 5% in yield, I'm a little over 10%. So that's kind of what I'm looking for from IBM, and it is delivered. So Pinnacle West is another one. I've got I don't know, $35,000 worth of that. It has I've been investing in it since 21 as well, so it's been a couple of years. So it's been actually just the market return has been a 10% per year. And then my yield on cost is also nearly 5%. So, that's actually been returning about 15% per year for me. T. Rowe Price, we, saw that they issued earnings this week, and the stock went up quite a bit. So I'm not sure that that's really a fair comparison, but they are 10% of this portfolio. It's got a 15% return. I really haven't been investing that long in T. Rowe Price in this particular account, but it's also got a yield on cost of about 4.4%. So that's turned out very well. I just started this year, I think in February, investing in Altria, which is ticker symbol MO. It is about 8% of this portfolio. The gain in this particular stock is almost break even, but I am getting about 8.3% in dividend yield. So that's, between 8 and 10%. So it's producing what it should. Let's look at one more, Prudential. I sold off Prudential at the end of the year, did some tax loss harvesting. And so, I started buying it back again in February. It's up 6.5% with a 5.5% yield on cost. So you can see how this Income Factory Light works for me in my particular situation, because I'm looking for stocks that are paying a good dividend, but also growing their business. They don't have to grow it by much, but they do have to grow some. And I want to see that dividend growing on an annual basis. So they're providing me with a lot of income, which is, $1,100 a month in income from a $320,000 investment. that's, I think, pretty good. And that's just the cash return. I can take that out. I don't have to mess with the shares, and I can spend that money, or I can reinvest it, whichever I choose to do. So these are what I consider income factory light. I call it the income factory hybrid strategy. These work for me, and I think these might be appropriate at any age if you've got a reason for this income, this dividend income. So I wanted to share that as a potential strategy related to this book. But again, I would suggest that you read this book. Don't just take what I say. Just read the book. But I wanted to kind of whet your appetite on that and to see how you might use that moving forward. So now at the end of the day, what am I going to do? I'm going to develop an investing strategy that includes equities. I'm not just looking for income producing items that are going to go down over time. I'm looking for an investing strategy that includes equities. And as a matter of fact, I'm going to link to my investing strategy at the end of this video. I did a video on that, I don't know, a couple of 3 weeks ago. So I will share that with you at the end of this video. You can click on that and see what my strategy is. And then what's important, item number 2 here, is to learn to control the psychological and emotional responses that cause us to underperform as investors. That's a whole subject in and of itself. Might be fun to do a video on that sometime, but just recognize that there's these emotions and the psychology that comes to play that make us do things that we think are the right things, but they end up driving us to underperformance. We need to get those out of our lives. And then the third thing I would suggest is find an investing community that helps you be accountable for your portfolio. If you don't have that in your life now, I would suggest that you join a Discord community that I belong to. It is one that has been prepared by my buddy Ryan Williams. I'm going to link that in the description to this YouTube video. And, if you join that, it is free to join. There's thousands of people in there. It's basically a chat group that's organized in categories so that we can talk about particular stocks and get people's opinions and thoughts. And there's a lot of people who are very knowledgeable, and I really enjoy that. I actually check in on that Discord every day. Because I think there's a lot of good content in there. So that is the third thing. Find this investing community where you can hold yourself accountable. So I am not planning on creating an income factory. I have already created an income factory light on a certain portion of my portfolio. I will probably build that over time as I age and get older and need that income more. So, I think this is a great book. It's a great read. But don't let the assumptions that are in this book cloud your vision about building your future. Hopefully that wasn't mean, but it's just the way I feel about it. So if you like content like this, give me a thumbs up on the video. It lets others know that the content in here is worthwhile, worth listening to. And also, if you haven't subscribed, do that. And I would love to see you on the next video. And again, I'm going to share with you my investing strategy here, and then a link that you can join the channel here. So with that, I will see you on the next video.